Most Canadians know the basics. File by April 30th, pay on time or there's interest, and do not ignore CRA. But here's what very few people really understand. Why your refund suddenly disappears, how CRA can garnish your income without going through a normal court process, and why CRA interest is basically a high interest, non-deductible loan, and how one messy year with CRA can quietly snowball into years of drag on your wealth. If you've ever thought, I filed a bit late, I'll just deal with it later, how bad can it really be? This video is the advanced version of that answer. Hi, I'm Yudhvir Kabuli. I'm a chartered professional accountant and a chartered financial analyst with over half a decade of Big Four Canadian corporate experience. Here's a quick but important note. This video is for educational purposes only. It is not personal tax, legal, or financial advice. And in today's video, we're going to cover number 1, why your refund can disappear into old debts. Number 2, how CRA interest compares to investment returns and other debt. Number 3, installment interest and penalties and how to minimize them. Number 4, CRA's collection powers and what actually happens if you end up ignoring them. Number 5, a quick practical look at taxpayer relief. Number 6, a simple priority of payment frameworks where CRA debt sits relative to your mortgage, HELOC, credit cards, and investing. This is the stuff most people only learn after something has already gone wrong. So stick with me and let's get ahead. We'll start with refunds. You file your return, your software says you should get an $1,800 refund. You feel pretty good about it, don't you? Then your notice of assessment shows up and it says refund $0. Balance owing from previous years reduced. What just happened? CRA has the right to offset money that they owe you against money that you owe them. That can include prior year personal income tax, some GST or HST debts, and certain benefit overpayments. So instead of sending you cash, CRA just uses your refund to pay down your old debt. The two big takeaways are, number 1, a projected refund in your tax software is not guaranteed cash if you already owe CRA. And number 2, if you're behind on past year's filings, current year returns can still be incredibly valuable. Your refunds will automatically go towards cleaning up the previous balance. So the mindset shift is, don't avoid filing just because you're worried about what you owe. Filing is step 1 in getting CRA debt under control. Now let's zoom out and talk about CRA interest. CRA charges arrears interest on late paid income tax, CPP and EI amounts, late or insufficient installments, and late GST or HST remittances. The interest paid is at a prescribed rate that CRA updates every quarter. On overdue balances, they charge that rate plus a spread, and they compound it daily. In recent periods, that's landed in the high single digits for overdue tax. So think roughly in the 8 to 10% range as an example, depending on the quarter. Now layer on 2 facts. That interest is generally not tax deductible for individuals. You don't get a tax write-off for it. And it compounds every single day until you actually pay it. Now compare that to a balanced investment portfolio that might have a long-term expected return in the 8 to 10% range, or even your mortgage at 4 to 6%. So I want you to think from a wealth management lens. Carrying unpaid CRA debt at say 8 to 10%, non-deductible, compound daily, it is much worse than most realistic investment returns and many other forms of debt. So the way I want to frame it for you is, paying down CRA arrears is like getting a risk-free after-tax return equal to CRA's prescribed interest rate. For a lot of people, that means unpaid CRA balances should sit very high on the priority list, right alongside high-interest consumer debt. Let's now go one level deeper on installments. If CRA tells you to pay tax installments and you don't, 2 things can hit you. Number 1, installment interest. Number 2, installment penalties. Installment interest works the same way. Prescribed rate, daily compounding, charged on the difference between what you should have paid and what you actually paid. If that interest gets big enough, CRA can also add an installment penalty, basically a surcharge already on top of that high interest. So here's the part most people never actually hear about. CRA uses 3 different methods to calculate what you should have paid. The no calculation option based on CRA's installment reminders, the prior year option, and the current year option. By default, CRA assumes their own method, but when your return is prepared, you or your CPA can choose the method that results in the lowest installment interest. So if your income is volatile, let's say you had a spike one year, then it dropped, you don't have to blindly accept the installment amounts printed on that letter. Instead, the advanced move is, when installment reminders show up, ask your CPA, which method actually minimizes interest for me? That one question can quietly save you hundreds or thousands of dollars over a few years. Now let's talk about CRA's collection powers. This is what makes CRA very different from just any normal lender. Because if you ignore tax debt for long enough, CRA can quickly escalate from friendly reminders to actual legal action. And here are the big levers CRA has. First, CRA can garnish income. They can legally require your employer to send them a portion of your paycheck every paycheck, or certain payers like contract clients or pension administrators to redirect part of your payments to CRA. So less money actually hits your bank account because the slice is going straight to the government until you pay off the tax owed. Second, they can freeze or seize all your bank account. CRA can issue a requirement to your bank to freeze funds and remit money directly to them to cover your pending tax debt. Third, they can even place liens on your property. CRA can register a lien on your home or even other real estate. That doesn't mean you're getting kicked out tomorrow, but it can affect refinances, sales, and it ensures that CRA gets paid out of the proceeds. And in more serious, persistent cases, your assets can actually be seized and sold at fire prices. That's less common, but it is in the toolkit for CRA. The tone I want you to hear from all of this is this. I'm not telling you this to scare you. I'm just telling you so you don't treat CRA like any other credit card. Their toolkit is often broader, faster, and sharper than any typical lender. Now let's move on to a bit of hope. Taxpayer relief. The CRA does have the authority in certain circumstances to cancel or even waive interest and your penalties. They usually do not waive the original tax you owed them, but they might be able to give you relief on the cost of at least you being late. Some of the situations where relief might be considered include serious illness or accident, unfortunately the death in your immediate family, natural disasters, major life events that generally made it unreasonable for you to pay or file on time, or cases where CRA itself made a clear error or delay. You usually apply through a detailed written request or through CRA's current taxpayer relief form. You explain what happened and you provide all supporting documentation and then let CRA decide. So the key message is taxpayer relief is discretionary. It is case by case and it is not guaranteed. So don't build a strategy assuming CRA will forgive your interest. But if there was a period where life truly blindsided you, taxpayer relief is a tool worth knowing about. And here's a quick myth buster. Does CRA debt show up on your credit report? Not like a normal credit card. CRA tax debt isn't typically listed as a standard trade line on your Equifax or TransUnion report. But that doesn't mean it's harmless. If CRA registers a lien on your property, it will show up in searches and affect all of your refinances or sales. If CRA is garnishing your income, your real-world ability to qualify for other credit is obviously impacted, even if the word CRA isn't directly printed on your credit report. So the line is, just because you don't CRA on your credit report, it does not mean CRA debt is not a big deal. It runs on a different racetrack. Now, we'll talk about where CRA debt sits in your priority of payments. I want you to imagine this. You have a mortgage at 5%, a HELOC at 6%, a credit card at 20%, some CRA arrears at say 8 to 10%, and you're also investing. So you might ask, where should extra cash go? There is no universal rule, but a practical ranking often looks like this. Number 1, clear that high interest consumer debt. Credit cards, payday loans, store financing at the 19% plus. Number 2, prioritize CRA debt and overdue GSE or HSC because it is now non-deductible, compounding daily, and backed by strong collection powers we spoke about. Number 3, other unsecured or moderate rate loans. Lines of credit, maybe your car loans. Number 4, mortgage and HELOC, depending on the rate and your risk tolerance. Number 5, new investing beyond any bare minimum retirement contributions or employer matches. The details will vary person to person, but the big idea for you is this. Unpaid CRA balances are not neutral. They belong near the top of the paydown list right alongside other bad debt. And for the higher net worth viewers, yes, there are situations where it could be strategic to carry a tax balance, but only for a short period of time while you liquidate assets carefully. But that should be a conscious model decision with your advisor, not just something that you let happen by accident. So let's wrap up this advanced video to avoid problems in the first place. Step 1. Turn on CRA notifications. I want you to log into your CRA My account after this video, enable email notifications for new mail and statements. Do not rely only on the brown envelopes. Step 2. Build a CRA and HST cash bucket. If you're self-employed or incorporated, have a separate savings account for tax and HST. Every time money comes in, sweep a fixed percentage into that bucket. Step 3. Calendar your critical dates with buffers. Personal tax, April 30th payment. June 15th filing if you're self-employed. Installments, March 15th, June 15th, September 15th, and December 15th. For GST or HST, 1 month after your month or quarter end, or roughly 3 months after year end if you're annual. Set reminders at least 2 weeks before, and again 2 days before each of those dates. Step 4. Schedule 1 tax strategy meeting per year with your CPA. Use it to check whether your installment should be adjusted and decide if it's a big RSP year or not. Plan any large asset sales that could trigger big capital gains, and model out what happens if you prepay CRA versus investing. That's how you move from reactive tax behavior to proactive controlled decisions. So a quick recap. In this deeper video, you learned that CRA can offset refunds against old balances, so a projected refund might never even hit your account. CRA interest on overdue balances is often in the high single digits. It is non-deductible and it compounds daily. That makes CRA debt a priority for you to clear. Installment interest and penalties can sometimes be reduced by choosing the right calculation method. CRA's collection powers go far beyond a normal lender. Garnishments, bank freezes, liens on your property. And don't forget the Taxpayer Relief Program exists, and in genuine hardship, it can sometimes remove interest and penalties. But it's only a safety valve, not a strategy. And from a wealth perspective, unpaid CRA balances belong near the top of your paydown list, right up there with high interest consumer debt. Once again, I'm Yudhvir Kabuli, CPA and CFA. Thanks for watching, and I'll see you in the next episode of The Canadian Dream.